You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Now, our guest for this week's show is a real estate developer and founder of Rooney Properties, Jim Rooney. Now, Rooney Properties is a Wisconsin-based development and management firm specializing in multifamily, senior housing, and student housing projects. Now, over the last 25 years, the team has been responsible for the development of hundreds of millions of dollars worth of projects. Now, here's what you're going to learn in our show today with Jim. You're going to learn how Jim got started initially in the sales side of residential real estate prior to moving into the investment side of the business. Even more interesting than that, he was a pipeline laborer prior to getting into real estate. You learn how to leverage an entry-level position with a property management company to get firsthand experience in the operations and management side of whatever asset type you're seeking to own. For example, if you want to own multifamily apartment complexes, then go get a job as a leasing agent at a large apartment complex. Okay, we're going to talk about that in the show as well. You're going to learn how Jim was able to make it through the 2008 downturn, even though he had a significant amount of undeveloped land, which was a major liability. You're going to learn about the importance of establishing local banking relationships and how these key relationships help provide funding to Jim's business during very critical times, more specifically during the Great Recession. You're going to learn what criteria Jim used to determine demand when seeking a new market to develop multifamily in, and it's actually a very simple formula, yet very, very powerful. So I'm excited to share that with you. You'll learn how to properly budget the necessary time frame during the construction and lease-up phase when developing multifamily. Jim and I are also going to talk about whether or not to use in-house construction or outsource to a general contractor when developing new projects, and which one Jim prefers and why. You can learn about Jim's involvement in the student housing business and senior living and why he's equally as excited about these two different asset types as he is with multifamily, and much, much more. And so with that, guys, I'm excited to get onto the show with Jim. But before we do, just have a few quick housekeeping items I'd like to run through. Like I do each and every week, I like to go through my one personal and one professional best of the prior week. So one personal best I'll start off with, and it's a new year, guys. It's 2020. And I'm here with you, and for that, I'm eternally grateful. Simple as that. New decade, fresh decade. The last decade, we kicked ass, and looking to kick some ass here in 2020 and thereafter, okay? As far as a professional best, I recently got invited to participate on an alternate investment panel at the Best Ever Real Estate Conference in February. It's held out in Colorado. Typically used to be in Denver. This year they're doing it in Keystone, which is a ski resort about an hour and a half outside of Denver. This will actually be my third year of speaking at the conference. And if you're not familiar with him, Joe Fairless is the one that puts it on. And he and his team put on an incredibly solid event. And I'd say if you're on the fence about going, I'd highly suggest that you attend. It's just a great networking opportunity. Lots of very brilliant individuals speaking on the numerous different panels. It's not just multifamily related. There's a variety of topics that are covered over those couple of days of the conference. And also come find me and introduce yourself and let me buy you a drink. So it'd be great to meet you in person. Hey guys, moving on here. If you love what we're doing here at the Real Estate Investing for Cash Flow podcast, be sure to subscribe to the show and leave a review and rating on iTunes. And like I do every week, I like to give a shout out to one of our listeners who's taking the time to leave the review. This week, the review is from Greg Helbeck. And Greg says, Kevin provides a ton of value in every episode. It really got my mind thinking more commercial cash flow. Amazing value provided on a daily basis. Thank you so much. Well, Greg, thank you. Appreciate you taking the time to leave that review. Moving on here, guys, one last thing before we get rolling with the show. Just want to remind you of the free 30-minute phone call I offer each and every Friday where folks just like you can sign up via my website, kevinbupp.com, and we can jump on the phone and talk about everything and anything your heart desires about real estate investing. Whether you're brand new or you're a seasoned pro, it doesn't really matter. It's a way for you and I to connect and for me to hopefully give you some value to help you grow in your business. Again, go to my website, kevinbupp.com, to sign up, and I'll look forward to chatting with you. Now, guys, without further ado, I'd like to get on to the part of the show that you've been waiting for, which is our show with Jim Rooney. So here we go. Alrighty, guys, it is my honor to introduce my guest for today's show, real estate developer and founder of Rooney Properties, Jim Rooney. Jim, how you doing today?
Doing well, thank you.
Yeah, thanks for joining us here. Just to give our listeners a sense of geography, where are you based out of today? Where are we calling you from?
My home is in Chippewa Falls, Wisconsin. That's where our home office is. Most of our development activity has been in this area. In the last few years, we've branched out to Colorado and looking at other opportunities outside our area. But I'm in Chippewa Falls, Wisconsin today.
Okay, fantastic. And for those folks that aren't familiar with you or your group, what I'd love to do in the beginning of each and every one of our shows is just take a few minutes and kind of pass the mic back to you and ask that you maybe share a little bit of your background. I mean, you've been doing this for 23 plus years. Just how you got started, how you ultimately ended up in real estate, and what brought you to where you're at today.
Sure. I don't think about how many years until you said 23 there, and as I'm doing the math in my head, I'm thinking, so maybe the resume is not too updated. I guess it's 25, because really I got into real estate in 1994, came from a background of pipeline construction, which really doesn't set you up too good for the real estate world, other than you get to see a lot of it. And I got involved in real estate sales initially, but I got into real estate sales with an interest in owning real estate, not necessarily just buying or helping other people buy and sell real estate. So that's kind of where it came from.
Okay. And how'd that look? I mean, what was that first transitional step for you? So you said pipe laying. Is that what you what your background was initially prior to getting into the sales side? Is that okay?
Yeah. So
let's talk about that transition, because that's a big one. Just that initial step, going from being more on the labor side of things to actually getting into a sales position. I mean, that's a fairly large transition, and then transitioning from the sales position to ultimately becoming a developer, running projects, much different risk profile, right, than the other two. So what do those different transitionary periods look like for you? Yeah,
absolutely. So that was a pretty big leap going from my dad did pipeline construction, and I did it actually going back to high school. When I was 16, I was working in the oil fields, did it through college, and at somewhere, I guess I'd have been 27 or 28, I decided I didn't want to do that for the rest of my life. Looked at things that I could do in Wisconsin. This is the mid-90s, keep in mind. And small town western Wisconsin is not exactly ripe with opportunity. I always liked real estate, and part of why I liked it so much was I looked at my parents who worked hard their whole life, and my dad always had a very good income. He worked union construction, but he made a handful of small real estate investments, mostly just buying the family farm and renting the farmland or things like that. And I recognized that my dad had contributed more to his wealth with one or two small real estate investments than 40 or 50 years of hard work. So that inspired me to be entrepreneurial. And I wanted to get into real estate. I had a couple friends in real estate, and they said, they suggested to me sales because it gets you in the game. And so I got into real estate sales. I was surprised that I did pretty good at it. And in hindsight, looking back, real estate sales is, I mean, if you show up and go to work, you're in the top 25% right off the bat. So that seemed pretty easy to me. But immediately, I had an interest in owning real estate, not just helping other people buy and sell it. And so it took me a couple years as selling real estate to get enough money saved up where I could start doing some investing. And, this is all pre-real estate bubble of 2007. So back, and I think I don't think just because it's 20 years later, there's still a lot of these same opportunities exist. But back then, we could go out and buy a house and convert it to a rental unit or buy a duplex, those kind of things, and get into it without very much money. And it was a little bit of creative financing. We'd buy a $100,000 house that was a $100,000 house, and then we'd rent it for $1,200 a month and go to the bank, and they say, oh, this is a rental property. Now it's worth $120,000. Get an 80% loan. They give you 96 grand back. You're into that house for $4,000. So that was some of the the early starts. As the deals get bigger, that kind of financing is a whole lot harder to do.
Mm-hmm.
But I think today anybody can go do what I just described there.
Mm-hmm. No, absolutely, and I think that getting in, getting in on the sales side is a great way to get exposed to the business. Assuming that you're working with, some of your clients might be investors that are actually buying those properties as investments or rental properties. Another great way that I suggest to new folks that are just kind of stepping into the game is, I guess first and foremost, kind of make a decision or at least think through of what part of real estate you'd like to ultimately be involved in. There's many different aspects and varieties that exist in the investment world. And what I mean by that is, like, do you see yourself owning residential rental property? Would you prefer to own the building downtown, the office building, the senior care facility, what have you? You might not know that from the get-go, but where I'm going with this is getting involved in the property management side of things. I mean, the operations, finding the deals is one thing, but actually the operations is equally, if not more important than actually taking down a deal on the front side. If you buy a great deal, if you don't operate it well, then it's no longer a great deal. And so getting involved in the property management side, especially those that want to get into residential real estate, go team up with a large multifamily property management company, get in the ground floor there, learn the intricacies of that business behind the scenes, or get with a large single family residential management company, what have you. And if you want to be on the commercial side, do the same thing, but get involved with a leasing company, commercial leasing company, and learn the intricacies of that business. And I think that goes a long way. And it could just be it's a means to an end, right? Like, it's just a stepping stone, but I think it's a great way to get started, again, either on the sales side like you did, or on the property management side. I'd love to, do you agree with that statement as a good venue or a good route for those folks getting into the space?
Absolutely. As I think, so my first rental property was a lot scarier than going out and building 200 today. And the first few units I bought with a partner who had some property management experience. So I was kind of the deal finder. I had a little more financial capability than he did. And he was the guy that was helping to lease them. So I did get a little bit of experience in the first. So we bought like 10 houses over a couple of years, and mostly student rentals early on. And that's where I got my experience with the rental side. But I think you're very spot on there. There's a book called Rich Dad, Poor Dad, and he talks about in that book taking a job that will help you reach your goals, not just being an engineer because you want to be an engineer, because you want to learn the aerospace business or the automotive business or whatever it is that you're doing. And I think you can say that same thing about real estate. So I didn't have an abundance of on-the-job experience, but I got some from my friend that I started investing with. And I also have my father and mother-in-law had been in property management for quite a while. So although most of what I did was separate from them, it was a very nice source to be able to go to and ask for advice. So that helped a lot. But I agree with what you just said there. Well,
I think the important point there as well is just you quickly identified maybe what your strengths were and also maybe what some of your weaker points were, right? The strength was creative deal making, financing side, like you understood the intricacies of that much more than you did of the operations, but you had a friend, a business partner. You also had some family members that had that other experience that you might not have been excellent at just yet, right? And it's going to come in over time as you dig into more and more properties and own more units. But I think just understanding in the get-go, what those strengths and weaknesses are. A lot of people struggle with that. They think they can do everything, and they think that they should actually be great at everything, and that's just not the case. And so the quicker that you come to the realization that you're going to suck at certain stuff, and just be honest with yourself, that's good. Get that out of the way. Go find someone else that enjoys the part that you suck at and bring them on your team or partner with them and let them do what they love to do. And you focus on what you're great at. So
you hit the nail on the head. We found a lot of things that we sucked at quite a bit. But I've heard the phrase tuition is paid in a variety of ways. And I've paid my share of tuition in the real estate business through developing and property owning or ownership and property management, single family developing, multifamily building, all the above. It took some time, but we found through the process that what we're best at, and that's what we do the most of now. We have found that we're very good at identifying, building from the ground up, stabilizing and operating multifamily communities. And it was not immediate. You know, we had the spitball approach. We did everything. We did a lot of land development, and some of the land development occurred with an intent to try to create multifamily property sites. So zoning, I mean, over the last 20 years, things have changed a lot, but 20 years ago or back in 2000, it was really difficult to get multifamily zoning for where we live in Wisconsin. So what we found as a way to do that was to buy a large parcel of land. And we bought several that were anywhere from 100 to 250 acres and master plan the whole community. And some of the underlying incentive for that was that if we master plan, say 200 acres and it's 600 units, that we could find within that community room for 100 or 200 multifamily units that we could then build and own. And so we did that. Believe it or not, we still own a lot of single family zoned land within those communities because partly because of the real estate crash in 07 and 08. We had a lot of stuff that was master planned that nothing happened with it for 5 or 6 years. And we were able to survive the real estate downturn actually quite well because of the fact that we had a lot of investment properties. So we were never beholden to having to sell to make cash flow. We always had a lot of rental property that was generating cash flow. And so
That's
that
great.
was, yeah.
I don't want to skip over that. And it was a part I wanted to ask you about, but we got to a little sooner than what I expected. But let's hit on it now that we're there. You know, speaking to the Great Recession and speaking to these master plan communities. I mean, you built these master plan communities, or you developed these master plan communities with the intent to kind of find that loophole so that you could develop these 100, 200 unit multifamily properties. But that leaves you with a lot of excess land, a lot of money tied up in excess land. And so no one really forecasted the recession, and I'm assuming that you guys even though you made it through, you would have planned your business slightly differently as far as getting involved in some of these larger master plan projects, knowing that the recession was coming, right? Knowing that you might not be able to sell off a lot of these single family lots or some of the other properties that you had developed there. And so, with that being said, I mean, is there anything that you would have done differently? Although you did make it through fairly unscathed, is there anything you would have done differently knowing that the recession was looming a couple of years ahead when you got in some of these larger development projects?
Absolutely. I think, anybody that came through that says they wouldn't have done anything different would be pretty ingenious, I would say. But we did okay. We built, I'll answer your question, I guess first. Is we had a lot of inventory. So I live in Chippewa Falls, Wisconsin. It's adjacent to Eau Claire, Wisconsin, and a nearby town is Menominee, Wisconsin. So they're the three biggest towns that together represent 100 to 150,000 population. Not real big, but we've done developments in all three of them, single family and multifamily. And the downside for us was we wound up with a lot of inventory, a lot of land inventory, a lot of improved lot inventory. And Wisconsin has high property taxes, higher than most states. So when you're carrying a lot of inventory, it's expensive. The property tax, some of these were part of homeowners associations that we had fees that we contributed to and so on. I can remember 20 years ago meeting other developers at like the National Home Builders Convention and things like that, and them thinking that we were crazy because we inventoried land. And in hindsight, they were correct. One of the things about inventory and land in Wisconsin versus a large market, Denver, Chicago, Houston, pick one, is the land cost is quite nominal, but it's still, it ties up a lot of money, and the carrying cost is significant. So to do something different, I would for sure would have avoided ever owning that much land. We still own a lot of it. And we were in the single family home building business up until 2014. So all those projects that we developed, all those communities, we were doing the majority of the home building. And we absolutely recognized in 14, when we chose to get out of it, that we were getting out of it as the market was really getting better. And we laughed about it and said, yeah, we know, but this isn't what we do best, and we want to be done with it. And we've since partnered with a couple local home builders that are burning through our inventory of remaining lots at a great pace. Kind of nice now that land's all, some of it we acquired 20 years ago, so our debt is either non-existent or the initial land cost was nominal. So we're starting to benefit from that, but it really, I would not have done that if I could do it over. The one thing that we did do really right during the real estate recession was we built more than anybody in our area. When 2007 and 8 rolled around, nobody was building, and there was a 5-year period where we represented about 50+% of the building permit dollars, residential related building permit dollars in our 3 communities. And, a variety of reasons why we could do that. Anybody that was dependent on sales was in a cash flow crunch. We always were very focused on the rental side of things and the long-term income from that. But, and there were some great deals in 08, 09, 10. The biggest project we ever did, we bought the land in 08 and brought units online in 2010. And nobody was doing anything at that time. So that was the upside of the real estate recession for us.
Yeah. Well, so that's great. That's great. It segues into another question I have regarding the financing side. So, you spoke to the population between the 3 different markets that you represent, about 150,000 combined population, which is very small in the grand scheme of things. And so, especially during a recession, right? I mean, like it's, you're talking about a much more micro level, impact being felt when you're in a small town, small market like that. So ultimately, how did you guys not just pull through and get a project done, but like what that financing, how did the financing terms change? I mean, I'm assuming you probably had a lot of great local relationships with banks and lenders. Obviously, some banks didn't make it through. Some banks pulled back the reins. They couldn't lend anymore for a period of time. Everyone was fearing God, right? Everyone was so scared as to what was going to happen next. How were you guys still able to get projects done in that period of time? And how did your business model have to change in order to accomplish that?
Yeah, so that's a good question. And I would be remiss if I didn't include our pipeline business. In 2006, I started a pipeline services business that ties back to my roots, which was building cross-country natural gas and oil pipelines. It's what I did when I was younger. My family's always been a part of that. And in 2006, I started a business serving that industry that the company's called Environmental Reclamation Solutions. It exists today. And our primary service is we do the right-of-way reclamation of gas and oil pipelines. And where I'm going with all this is that business was doing pretty good through the recession. And so it generated cash flow, but that in itself would not have been what the banks want to see. They want to see people with some real estate history that survived the real estate recession or prospered even better. And so it just helped us. But we were always pretty committed to the long-term hold. And most of the rental properties really didn't lose value during that real estate recession. They maybe didn't go up like they're going up now, but they didn't lose value. So if you had a community, didn't matter if it was a single fourplex or 200 units. The rents always supported the debt service with some reasonable debt coverage ratio, and the banks really never got nervous. It wasn't like the values were dropping below the debt against it or any of that. So the banks were pretty friendly here. It helped big time. It helped that we had another business outside the real estate industry that helped supplement us cash wise. But
yeah, no, got it. As far as the banking is concerned, I mean, have most of your relationships been on a local level or local to the project?
Yes, very much so. So that's probably different from a lot of real estate investors that you might talk to. Everything that we own, we built from the ground up. And I'm not saying that that's the only way to do it. We just always felt like we were creating equity by taking a piece of land, whether it meant the roads were in and we just built on the land, or if it meant really raw land that we put the roads and utilities in and built the apartment communities within that. We lost my train of thought there. So what was the question again? Back up, tell me the question.
Yeah, just regarding the local lenders. I mean, have you?
Oh yeah, yes. Sorry. So
that's okay.
The lenders that doing development or doing construction loans is a little bit harder than buying a stabilized property. And dealing with national lenders, it gets a little bit tough there. The local lenders were a lot more comfortable with doing a construction project that's right down the street. They can watch it happen. They had a pretty good feel for what was going on in the market. So we started out doing all local banks and community banks, not the national, the Wells Fargo and the Bank of America and those kind of banks, but the small local lenders. And we actually created a different problem in that these are smaller banks, so they all have lending limits. So we've used almost every bank in our community for our smaller projects. Fast forward 10 plus years since the recession, and our portfolio has grown quite a bit. We are now at a point where we're starting to refinance some of these projects and look at long-term non-recourse debt, which frees up some of those early banks. But it was absolutely local lenders, small banks that were behind us in the early days.
Yeah. So I'm assuming we say non-recourse, agency debt, Fannie Mae, Freddie Mac are probably the primary go-to that you're looking at this point.
Absolutely. So we have some projects. One that we did in 2010 that we did multi-phase that was finished in 2015, and the last part of it had a 5-year note on it, which is coming up next summer, and that's the perfect type of community to take and roll into agency debt. It's
Absolutely.
Stabilized there. It's a great deal, and it gets that personally guaranteed debt off our balance sheet.
That's always a good thing.
Amen.
Speaking to the feasibility of a new project, what's the process that you guys go through to determine that this particular market, pick any one, that this particular market can absorb an additional 100, 200, 300 units of the type that you're looking to build there? What does that process look like for you?
So that's a great question, and it's a great segue into kind of the next phase or story of our real estate development and growth. We recognized at some point along the way between 2010 and 2015 that we owned an awful lot of real estate in a small market. At that point, or currently, I think it's about 600 or 700 units in a small 3-city community of a little over 100,000 people. So thinking way down the road, it crossed my mind, okay, what if we want to exit this? How do we get out of it? And in a small market, you have fewer buyers, and we have a large enough market share that we would impact the price if we started trying to sell a lot of it. So we also, through the real estate recession, just saw a lot of opportunities elsewhere. And I would say about 2013, 14, I started really investigating, looking at other opportunities. And the way that we started, first off, Wisconsin is a great place to live. I've lived here my whole life. It's not a fast growth location.
Mm-hmm.
And I've watched and read and observed everything, Las Vegas, Phoenix, California, Miami, all those kind of markets where there's a lot of activity. And while I'm cautious to jump on the hot bandwagon, it seemed very logical to try and invest in real estate in front of the population growth. So we just made a conscious decision to pursue opportunities. And I looked at 3 states primarily. It was Florida, Texas, and Colorado. And we did some investigating in each of those states. We chose those states because there were areas within each of them where there was a lot of growth. Mm-hmm. We wound up settling on Colorado for a variety of reasons. Have some relatives out there, wound up with my oldest kid going to school there. It made some convenient reasons to have a real estate investment out there. So once we said, okay, we're going to look at Colorado, how do we choose a market? And we looked from Colorado Springs to Fort Collins, which is plus or minus 75 miles north and south
mm-hmm.
of Denver, the whole Front Range, and we evaluated literally all of the communities that were of decent size, say 100,000 plus. And the way that we evaluated them was we looked at single-family building permits, multifamily building permits, and population growth. It's a really simple thing, but if what we were looking for was where there was a divergence between the single-family and multifamily development relative to the population growth. If they're building
mm-hmm.
all kinds, and we found communities that were just booming with zero multifamily growth in them. Lots of single-family, no multifamily. So that was what we looked at. And when we're looking at such a big area like the Front Range of Colorado, there was numerous opportunities. And once we identified, I think we came up with 5 or 6 that we thought were the best opportunities. I like to say we interviewed the cities, because part of going through the real estate development process is you go through a lot of planning commission and council meetings and a lot of opposition and adversity. Rarely does anybody go, oh, thank God the real estate developer's here. So we've had our teeth kicked in plenty of times at these deals, and we think we're doing a great thing for the community, and it just feels a little bit rough when you sit and listen to a council member berate you for building homes in that community and bringing tax dollars in and so on. So these are some of the things that, when I was 35 years old, I didn't appreciate as much. As I've gotten older, I go, I'm just not going to go through that anymore. I'm going to go where they're pretty happy to see us. So we picked the communities in the Front Range of Colorado where we felt like the underlying building trends were real favorable to us. And then we talked to the cities and said, hey, what's your feelings about building some multifamily product in your community? And if they even hiccuped, we just packed up our bags and went down the road to the next place. And we found 2 really good ones, and we chose one of those. So that was that process. It's a long answer to your question, but I felt like we really got wiser over the last 20 years with how we chose them.
Well, I think an important point to that you made there is that your prior experience was there in your local town where you grew up, your family grew up. I mean, the relationships were there; they were established. Many years worth of relationships established, and so you were going into a brand new market. I mean, a brand new market. No one knew you. You don't know them. You got to try to make that transition as easy as possible. And I think that you guys took the right approach. I mean, you surely only want to work with local municipalities that want to work with you, that see you as a benefit. And I get and I understand, being especially that we're in the manufactured housing space. You can't imagine how much adversity we face when we don't develop. However, we do go purchase communities that haven't been, sometimes haven't been all that well maintained, and they've already got a negative stigma attached to them. And we walk in with our capes on. We think we've got capes on, basically saying we're going to inject $500,000, $1 million into this property. We're going to do this, that, and the other, and improve the community and improve the quality of life, and basically get a smack in the face back. It's we're used to it now, but you would think that it would be the complete opposite. You think that folks would be very accepting of you bringing a high quality product into their marketplace, but it's just not the case a lot of times. So,
yeah, you understand it well.
Yeah, very much. Unfortunately,
I like that. I like that reference to the Cape. So maybe when I show up at the next one of these meetings, actually, I'm going out to Fort Collins, Colorado next week for a initial site plan conversation. I wonder what the city staff would do if I wore a cape in there.
Yeah, that'd be interesting. Hey,
I'll let you know.
Point of conversation, right?
Yeah,
it starts things off lighthearted. Yeah, I've got a funny story regarding one of the first communities that we bought. We owned a lot of apartments back in the day, and we bought this is in 2010 and 11, so market still wasn't all that great. Things were barely recovering, and we bought our first transition to manufactured housing space. We bought a distressed community in Atlanta, Georgia, and it was in the metro, Atlanta metro. However, it was in a smaller, incorporated town, and this community had been in receivership for a couple of years, and it was right across catty corner to the courthouse where basically the mayor was and the chief of police. That's where their offices were housed, and they had to drive past this thing every day. And it was in a great little town, great location. However, it had just had been distressed for many years. Slumlord owned it. Bank took it back. Bank did a horrible job of managing. They put a bad receiver in place. Receiver didn't really care about it. You know the story. Sure. And we went into this with this grand plan, and got the entire city council together. It was a small enough town where we basically had everyone there. Code enforcement, chief of police, mayor, and his staff, and everyone in this room with this really pretty plan. Colorful. We spent a good bit of money actually putting together this great presentation. The mayor was a very intimidating guy. He was about 6'4", handlebar mustache, bald head, and he was very quiet. Let us present our case. We were so excited, to be coming to this town and really cleaning up what this mess I had to look at every day. And he let us talk for about 20 minutes and simply looked at us and said, if you guys buy that property, you are wasting your money. Get the hell out of my town. I've been trying to shut that thing down for the past 3 years, and I'm not going to stop until it's closed.
Wow.
Yeah. That was his exact response. Maybe not in those exact words, but pretty much is what he said to us. And caught us off guard. We looked at each other, my partner and I at the time, and I forget how we responded. We were in such shock. I mean, it was a room full of people, and I thought it was a pleasant environment, and it turned the opposite direction very quickly. And we walked out of that room, and we looked at each other, and had the question, should we still buy this property? Because it was a great deal. I mean, we were stealing it, and sure. And we went ahead and we bought it. And ultimately, what occurred is we became really good friends with the code enforcement officer. We just basically said, "Here's an open line of communication. Here's what we're going to do. We're going to show you that we're going to do it. We're going to start pouring money back into this thing, getting out the riffraff, what have you, and turning this back into a place you guys can be proud of." And within a year, I received a personal phone call from the mayor apologizing and thanking us for what we had done for the community. And one of his staff members actually ended up living in our community and buying a home there and what have you. But so it was a good story. But we received a lot of that opposition along the way, very similar to that. That was probably the most aggressive ever. But
yeah, that's an amazing story. I'm still waiting on my first phone call from a city leader like that saying, "Wow, are we ever glad you came?"
Well, the funny part is that we are right in the middle of another kind of adverse situation with another mayor of another town in North Carolina, right at that exact time. And so I took advantage of that phone call and asked if he would write us a letter of recommendation to this other mayor that we were going through the same challenges with. And he did, but it didn't help that much until we actually got in and did the improvements, what have you. But moving on here, I don't want to digress too much. I want to ask about, it's really a backup here because I think we skipped over a very important step is, you got your start by buying these single family properties, these rental properties, mostly student housing. But really, when did that first development opportunity come into play? And what was it? I mean, was it just a single family property? Was it a multifamily? At some point, you made a transition, you made a leap from existing to building from the ground up. And that's when you determined that this is really your skill set. This is where you guys shine, by building from the ground up.
Yeah, it's a great question. So it was actually very early on. I started buying the student rental type stuff in, I think, 96, and in 97. And I was always looking to build. And part of why I was looking to build is something existed back then that still exists today. And it was, and the numbers don't matter whether you're talking about a couple 100,000 or 50 million, but back then you could take a piece of land, and I'll use this example. So I bought a piece of land near my real estate office that was in an area that was mostly multifamily housing. It was maybe an acre or acre and a half. And I got it approved through the city planning commission for 4-unit buildings. And the way the math worked on that, I think I paid $90,000 for this piece of land that back then that had all the city improvements in it and would accommodate 16 units. So that's like what, $5,000 or $6,000 a unit,
cheap.
20 years ago. And so I could build the buildings, and I think we spent $880,000 at that time. And now this is a long time ago, so I won't remember the dollars perfectly, but the point remains the same. Is I think we spent $880,000 all in, and that was land and buildings, but the appraised value was a little over $1 million. So when you go to the bank, you say, all right, I want to borrow 80% of this. You don't need 200,000. We needed 80. And that gave me the ability to buy more than if I went out and bought $1 million project that was all developed. I'd have to come up with 20%, $200,000. Here I could do it with 8%. And that was basically the delta or the benefit of doing the development. And we did that in 1997, 98, and recognized just the ability to buy more, to take your dollars and get more return on it. And so continued that process going forward. The other thing that we learned was, and we've built everything that we own, and because we built it all, we built it with the intent of holding it long term. So we built it pretty well, and it really starts to show up when a property gets 5 and 10 years old and older, where the maintenance cost just stays really low. A lot of developers all over the country build with the intent to build and sell.
That's it. Turn and burn. Yeah.
Yep. We're on this project in northern Colorado right now, and I mean, we're not even halfway done. Well, we're about halfway done now. But well before this, our phone is ringing from developers, from bankers. Everybody just knows that we're building it and you must be ready to sell it. And our answer is no. I've always joked that our investment horizon is lifetime plus 10 years. And when I walk in and talk to a city about that, or talk to a bank about that, it puts them in a different perspective how they're looking at us and our project. And for sure a city does, because they go, oh, this isn't somebody that's coming in here to do something, flip it and be on their way. And so that first project that we did in 1997 gave us the confidence to do a development. It wasn't big, it's 16 units. And we subsequently did another one that was about 20 units. And from there, they just got bigger and bigger. Now, kind of the target is, and we don't always get there, but about 200 units is a standalone community. And that's the right size to have the clubhouse and the pool and the on-site leasing staff and those kind of things. And so is that the size that you're building in Colorado right now? 200 units? Yeah, it's 176 units. And then there's a second phase that we just added, just acquired some more land that'll be 80 some units. So it'll be 250, 260. But that's a very common community size in any bigger market. Just it's where the economics work out for the clubhouse and the on-site staff and so on. So, do you mind sharing where you're building that, where you're building that community in Colorado, or? Yeah, absolutely. I thought you'd never ask. So it's a town called Timnath, which is right adjacent to Fort Collins. The community is called Timnath Trail, and great site. It's a half a mile off Interstate 25, so it's direct access south towards Denver and north into Cheyenne, Wyoming. Huge growth corridor all along I-25, and Timnath is booming in size. The city or town, it's actually the town of Timnath, just relocated their city hall and their fire department right across the street from our new community. Oh. And then there's a police department going right across the street. So it's all evolving. It's like a new city growing right where we're at there.
That's
so
great. And what are your projections from beginning to end, from the time you guys broke ground till not just completion of the project, but actually even making it through the lease up phase? What are your projections?
Yeah, so good question, and that was a real learning experience. We started looking. We had identified the site by early 2017. We're hoping to be under construction in early 2018, and we're really, I'm sorry, I missed that by a year. We identified it in 16. We're hoping to start construction in 17, and didn't get started until the summer of 18. So we started in July of 18, and we will be finished in February or March of this year with 176 units. So it took us about 18 months to build it out. Within about 3 months of completion, it'll be stabilized at 95% leased up. So about 24
months.
Yeah.
Wow.
Well, we have a little over 100 units built right now and 85 occupied. So I mean, we're tracking pretty close to the construction with the lease up. But, yet we also had a year time from the first unit to the last unit. So it's not like we leased the whole thing in 3 months. We leased it in 12 months, but it's getting there.
I'm on Google Earth right now trying to track your place down.
Okay.
Is it right there on East Harmony? Is that the...
it's East Harmony. So if you find there's on Harmony exit, there's a Walmart and a Costco.
Yeah.
And if you go east from the Walmart and Costco, you'll see the Poudre River. And if you look to the east of the Poudre River, a quarter mile on the south side of Harmony, that's where our site is. Now, I haven't looked at Google Earth in a while, so I don't even know if it's showing up on Google Earth. We have a drone fly over every couple times a month. So that's how we track activity along with the site camera. But does it even show anything on Google Earth there?
It does actually, but I don't know if it shows. I don't know if it shows everything that's actually there right now. So,
sure. Yeah.
Very interesting. So, are you? One of the other big questions I have, and then we're going to move on here, and I want to be respectful of your time. Is as far as overseeing of your projects, do you guys GC your own projects, or do you outsource to a third-party firm to assist with the construction side?
Yeah, great question. So all the stuff that we did in Wisconsin, we still have a construction company and GC'd all our own work. Branching out to Colorado was a new experience for us, and we approached it with the intent that we were going to go out there and be the general contractor for that. So we bid it, and keep in mind, when you're talking about 2017 building in northern Colorado, the building industry was and still is absolutely booming.
Yeah.
So we were very worried about our ability to be a new contractor into a market and be able to get good, reliable subcontractors and be able to get them to perform on our schedule. So we went through the whole process of bidding it, and we're ready to do that if we need it to. We had a lot of general contractors out there pursuing that project because it's a pretty sizable project and very interesting to the local contractors. And so we turned around and had, I think we had 5 or 6 bid it. And ultimately what we discovered was we could hire a general contractor there for not a whole lot different than what our cost was. And I suspect it was primarily because they were getting better pricing than we were going to get on our own. They had these relationships.
Yep.
So in the end, we hired a company there, and I'll give a little shout out to Brinkman Construction. They're a Fort Collins-based construction company, property development company. They've done a great job. So this is our biggest project ever as far as dollars, and it was a little bit intimidating to hand it off to somebody else instead of doing it ourselves. But we're very happy with the outcome there. We have had a owner's rep on site for 2 years, representing Rooney Properties and being involved. And it's a guy that has worked for us for a long time as a project manager. So he absolutely understood the real estate building and development business. And he did a great job. It's still ongoing, but he did a great job working through that general contractor. But that was the first experience we had with not building our own. And, every business evolves. One of our evolutions is, as I look to the future, and we talked earlier about, find what you do and do well and do that. We're pretty good at building and developing. But I think the developing side and bringing all the pieces together is more our strength than the actual brick and mortar and sticks and stones, if you will, of somebody assembling the pieces. So as we look to the future, we think that we'll do more developing and hiring other general contractors. And we're still the developer. The risk in those kind of projects falls on getting it from conception to stabilization. And that's why they're hard to finance. They're a lot less difficult to finance once you have numerous other projects that are stabilized and operational, which is where we find ourselves. So,
so do you have any other projects in Colorado teed up already?
We're working on a couple. So we're a couple months from being done with the first phase of this project, and a piece of land came up for sale right adjacent to us. It couldn't have been any better located. It's really the only site that abuts us that would have been available. And so we have that under contract to add a second phase for this. We expect to start next summer with the second phase and add another 80 units. There's some efficiencies of doing that. So we started with 176. When we add 82 more units, our staff doesn't grow much. Our clubhouse stays the same size, and the community performs a little better financially because of the economy of scales. So that's on the horizon. Second, so I should back up. We'd never talked about senior living, and all of our investment in Wisconsin had been, two exceptions, has always been market rate apartments. In 2014, we built a 202 bed student housing project that we still own. Like the student housing business, we're in a university town, so it, obviously you need that aspect of it. But going back probably 20 years, I always had some interest in senior living. It just seemed like the market's big and it's getting bigger. So we started pursuing that about 13 or 14. One of these sites that I referred to that we master planned. So we bought a bankrupt 18-hole golf course in 2012. Interesting closing. You were talking about going to the mayor and getting that speech. So I go to this closing. This bank called. I said no to them 3 times. They kept calling, why don't you buy this from us? And I didn't want it. I didn't want more single family lots because I knew it was going to be a lot of single family lot development. And 2012, there weren't a lot of buyers out there. And so I guess I said no twice. The third time they called, I said, okay, let's talk about it. So anyway, we agree and we make a deal to buy this golf course from the bank. And I went to the closing. It was an interesting closing because the bank's the seller, I'm the buyer. And the bank president and the loan officer, when we got done with the closing, busted out a bottle of Crown Royal whiskey. And I said, I've been at a lot of closings, but I've never been at one where the bank/seller started celebrating with whiskey neat the second I signed on the dotted line. And I said, sounds to me like I might have paid more than I had to. But anyway, I digress a little bit there. So
I don't. I wouldn't know if that's a good celebration or bad stuff. But did they just get me? Like, is there something I don't know here?
Right. Yeah. So that deal has turned out really good for us. It was on the right side of the single family recovery, and even though we didn't build most of the single family homes there, we've sold all the single family lots that were available, and built some apartments. We built one site in there that was 98 units, and we have the final site of another 48 units under construction. But when we master planned that golf course community, we master planned for a senior living facility, and we started in 14 and opened it in 2015, and it was a 99 unit senior living facility that had independent living, assisted living, and memory care. We knew absolutely nothing about that business. I just knew that I wanted to be in the real estate business related to senior housing. Mm-hmm. And so we did some research ahead of time, identified some regional management companies, and ultimately partnered with a management company out of Minneapolis to manage our facility. And they helped us through the development process. We got it up and stabilized. We decided, like, you referred early on about operations. We decided early on that we felt like we were more efficient on the operation side than this management company, and they're nonprofit. We absolutely try to be a for-profit business, and partnering with a nonprofit, just there are some different goals. Let's just leave it at that. So anyway, we decided that we would take over management of it. We took over management in 2015. And so we've been running it for 4 years now. It's gone really well. It's always been full. And this summer, we started an addition to it for another 36 units. So that will come on next summer. So just a little clip for the senior housing world. It's a great business. We like it. My wife is there every day. That's become her day job. That's her baby. Yeah, that's her baby. So I stay out of that. And back to your question about future projects. So we have another site in Fort Collins, Colorado that we recently put under contract. And we're in the process of getting a similar, about 100 unit senior housing community approved and then built in Fort Collins, Colorado. So
great market. Yeah, fantastic.
Yeah.
Well, Jim, I again, be respectful of your time here, and I want to move on to what I call the lightning round. And this is where I'm going to ask you 6 short, concise questions, looking for 6 short, concise answers. So let's get rolling here. The first one, your biggest fear, what is it?
Boy, that's a hard one for me to answer. I sometimes think I'm fearless, but what got me. I haven't given it any thought, but here it is. What got me into the real estate business was the fear of my financial security being dependent on somebody else. And a lot of people say, oh, I want to work for the government because it's secure, or I want to do this because it's secure. I had more faith in myself, and I said, I want to be able to control my income, control my destiny. And frankly, that's why I got out of when I was 27 years old, got out of the pipeline construction business, because I was not, no matter how much I wanted to work, I couldn't control a lot of things. And what I made in a year was what somebody else, that was the work. So my fear is somebody else controlling my financial security.
Got it. Like it. Okay. How about your one biggest regret?
That is, no answer is a bad answer, but I have just been militant about looking forward and not looking back.
Love it.
I guess I can give you an answer. I wish we hadn't gotten as much into the single family business as we did. It was a lot of work without a lot of financial benefit to it, but is it a regret? Not really. I mean, it's a lesson learned, and we, sometimes you gotta do more than one thing to find out what you're good at.
That's it. Your business might not have evolved to where it is today if it wasn't for a few of those don't even call them mistakes. I mean, just learning experiences along the way. Knowing
tuition
that
paid.
That's it. There you go. Love it. How about most influential business book?
Easiest question you've given me all day. It was Rich Dad, Poor Dad. I read it 20 some years ago. I bought numerous copies. I've given it to employees and friends, to my children. And he really drives home what I just talked about as my fear, somebody else being in charge of my financial security. In that book, they talk about controlling your own destiny and being an investor, a business owner, or whatever the case may be. So yeah, the book is Rich Dad, Poor Dad.
It's probably the most popular answer there for sure. How
Really?
about outside it? Yeah, no, absolutely. I mean, you talk about like the one probably most impactful business book of the folks I've had on the show, as far as like what was a transitional period and what pushed them or prompted them into, not just being an entrepreneur, but being a real estate entrepreneur. I'd say that book is probably, again, it is the most popular answer to that question for sure.
Good book.
Absolutely. How about outside of the daily work grind? What do you do to decompress?
I am not one of those guys that will get to retirement and say, what do I do now? Because I have lots of hobbies, and the top three, I have three boys, 21, 18, and 16. And so 2 are still in high school, 1's in college, and they all were very involved with football, baseball, and basketball. So I've watched an awful lot of those 3 sports the last 10, 12 years. That chapter's kind of nearing the end with the last 2 as a junior and senior in high school. But beyond that, I like to hunt, I like to golf, and I like to downhill ski a lot. And that gives me different things in different times of the year. So
that's the reason why you're starting to build stuff out in Colorado. So you can spend more time out in some real hills, right?
Amen, brother. My oldest, who went to college when it came that time, said, well, where do you want to go? He said, I want to go where I can snowboard. So he went to Colorado State. Now the second one's graduating high school, and he is accepted to Montana State. So there seems to be a trend there. And we just bought a place out in Montana for a ski home. So yeah, there's a trend.
Fantastic. I love it. How about the one thing that you can't live without?
I can't live without faith in God and my family.
Love it. Last one here, and you might have already answered it, but if one day you woke up, just decided that, I've kind of run my course with this development thing, I loved it, still kind of enjoy it, but not in love with it anymore. What would you do with your free time?
Boy, I have never thought about that. I love hunting. I love animals. I spend an enormous amount of time and money doing habitat enhancement so we own quite a bit of hunting land in Wisconsin and Illinois. And some of my friends say I'm a deer farmer, not a deer hunter, because I build habitat, I plant bedding, I grow food plots, and I rarely ever do much deer harvesting. So
got it.
That, and I love dogs, so something to do with animals and the outdoors.
Okay, fantastic. Jim, this has been an absolute pleasure. I really appreciate you coming on the show. I've had a lot of fun, learned a lot about you, a lot about your background and just the story along the way. And that's what it's all about. I mean, everyone's path is completely different than the next. We've all had challenges along the way, and you've had your fair share, but ultimately doing great things, making huge strides each and every day. And I really appreciate you taking the time to come on the show. I know you're incredibly busy, you got a lot of irons in the fire, it sounds like, but you ultimately took time out of your day here to spend it with us, and that's greatly appreciated. As far as the folks that are tuning in here that want to learn more about you and your company, my guess is that we should send them directly to your website, which is RooneyPropertiesWI.com. Is that the best place to learn more about you and what you've got going on?
Sure. Absolutely.
Okay. Fantastic. Well, guys, I'll put that in the show notes for you. And again, Jim, it's been an absolute pleasure having you here today. And guys, thank you to each and every one of you for tuning into this week's show. And until we meet again next week, this is your host, Kevin Bupp, wishing you huge success. You guys take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.